FX Nation, what's up guys? Welcome back to the channel. Welcome back to another video. As we continue our Trading with Market Makers 2024 video series, welcome to week number 9. So as we get into week number 9, guys, we've already covered a lot of information. If you haven't watched any of the 8 previous videos, please go back to FXM Mentoring 2024 playlist and check out those videos. If you're new to the channel, my name is Mark. I've been trading since 2011, and I'm just here to show you my trading strategy, every single part of it. So hopefully any part of this strategy can help you in your trading. So let's go ahead and get into this week's video, and let's go ahead and break down the next topic. So we're going to go ahead and break down exponential moving averages. Let's get right into it, and let's talk about what is the exponential moving averages that we use, and most importantly, why do we use them? Because everything that we use, everything that I show you in any of these videos has a purpose. If it doesn't have a purpose, it does not deserve to be as part of the strategy. So with that being said, exponential moving averages that we use, the EMAs that we use in our strategy, are the 5, the 13, the 50, the 200, and the 800 EMAs. Each of these moving averages serves a very specific purpose. The 5 EMA is a useful tool for extending your current trade. When price action stays above or below the 5 EMA, it can indicate that the trend is still strong, allowing you to hold onto your position longer with confidence. By using the 5 EMA as a dynamic guide, you can maximize your profits while staying in the trade as long as the trend remains intact. The 13 EMA is a versatile tool that we use in 2 key ways. The first is to enter a trade. So entry triggers with the 5 EMA crossover. So the first use of the 13 EMA is as an entry trigger. When the 5 EMA crosses over the 13 EMA, it signals for a potential trade entry opportunity, indicating a shift in momentum that can be used to initiate a position. So this is more commonly used for conservative traders that want to have those extra confirmations. The second way is confirmation of new peak formations with the 50 EMA crossover. So the second way to use this specific EMA is a confirmation tool for identifying new peak formations. When the 13 EMA crosses the 50, it serves as a strong signal that a new peak formation is occurring, helping to confirm the strength and direction of the new trend. The 50 EMA is often referred to as the baseline and is crucial for identifying the intraday trend on both the 15-minute and the 1-hour charts. This moving average helps traders gauge the overall direction of the market, allowing them to align their trades with the prevailing trend. When price action is above the 50 EMA, it indicates a bullish trend, while price action below it signals a bearish trend. This makes the 50 EMA an essential tool for staying on the right side of the market during intraday trading. The 200 EMA is often referred to as home base in our strategy. It's used to identify the longer-term trend direction and to gauge significant support and resistance levels within the market. On a 15-minute chart, the 200 EMA reflects the trend of the 1-hour chart, effectively mirroring the 50 EMA on the 1-hour chart. This makes the 200 EMA a crucial tool for understanding the broader market context and aligning your trades with the higher time frame trend, ensuring you stay in sync with the market's overall direction. The 800 EMA is a key indicator in our strategy, representing a very long-term trend. It is often used as a reference for major support or resistance levels and to gain a deeper understanding of the broader market context. On a 15-minute chart, the 800 EMA gives us a quick snapshot of the 4-hour chart trend, effectively mirroring the 50 EMA on the 4-hour chart. This makes the 800 EMA invaluable for aligning your intraday trades with the overall long-term market direction, ensuring you're trading in the direction of the dominant trend. These two trends, the 200 and the 800 EMA, guys, are especially crucial on the longer term. So the cool thing about these two on a 15-minute chart is that you, by looking at the 200 and the 800 on a 15-minute chart, you don't need to flip to the 4-hour or flip to the 1-hour to see what price action is doing, because immediately, just by looking at on a 15-minute chart, you could tell what the market is doing on those two other higher time frames. So it prevents you from having to switch back and forth between different time frames. An important aspect of the 50, 200, and the 800 EMAs is their role in providing key points of confirmation when identifying trade entries. When the price bounces off these EMAs, they often act as a dynamic support and resistance levels. This interaction serves as a strong signal that the trend is likely to continue in the direction of the bounce. Using these EMAs as moving support and resistance helps you confirm strength of the setup, increasing the confidence in your trade entry and aligning your position with the prevailing market trend. Another important aspect of the 50, 200, and 800 EMAs is that their usefulness as take profit targets. When these EMAs are present and align with your trade setup, they can serve as logical exit points for our strategy. So price action often gravitates towards these EMAs, especially when it has been separated from them for some time, as they act like magnets, drawing price back to them. Using these EMAs as take profit areas allows you to capture potential price movements as it retraces or continues its trend towards these key levels, helping you secure profits at strategic points in the market. Together, these EMAs provide a comprehensive view of the market across different time frames, allowing for more informed and strategic trading decisions. So let's take a look at some examples here of ways that we can use these EMAs. So in this example here, we're looking at a type 3 in London. You can see that price action comes out of the Asian session and comes back into the middle of the range, and you can see clearly all three EMAs are there, the 200 being the purple, the 50 being the blue, and the 200 being the white gray line there. You can see the reaction that we get from price action as soon as it gets to the middle of the range, and also hitting those EMAs as well. So in this example here, we can use the EMAs as a form of confirmation of the type 3 setup. In this example here as well, we can use again the 50 EMA. You can see in this example as a type 3, you see price action coming from the very top and down to the middle of the range where it meets the 50 EMA. Notice how price action does not go exactly to the middle of the range. Why is that? Well, it's because the 50 is acting as a dynamic form of support for price action. And then, of course, you can see what happens afterwards. The pinning to the 50 EMA is your extra confirmation that you want to see when you have these EMAs in your favor like this. Next, we have a type 2 trade setup where you can see the pattern here, the M pattern forming at the top of the Asian range, and you can see that the 200 EMA is riding across. Now, very important on this example is I want you to notice how the candles go above the 200 but immediately come back below it, okay, to form the two tops of the M pattern. Very important to understand that it's okay for price action to go above it as long as it comes right back immediately into the 200 EMA or whatever EMA you're bouncing off of. So again, this would be a great example of a confirmation for a type 2 pattern in the London session. Here we have a type 1 pattern, and you can see price action is bouncing off the 800 EMA, which is the purple line here. Again, same behavior. You can see price action bouncing off the 800 EMA while it's creating the M pattern, and so again, we can use it as forms of confirmation. Here we have the 50 EMA, and we can use it for two different setups. One is in London session for a type 3. In this case, we have an actual M forming in a type 3, which doesn't happen very often, but you can see here that still price action is acting, the EMAs is acting as a dynamic form of resistance here in the London session. When it comes to the US session, you can see again price is pinning and it's giving you a continuation trade in the New York session. Again, price confirming and acting, the 50 EMA acting as a dynamic form of resistance. Finally, here is another one for a continuation trade in the New York session as well. You can see price action came down from the Asian and then immediately retraced into the beginning of the New York session. The 50 is right there to act as that dynamic form of resistance to help price continue to push further down. All right, so now let's go ahead and go take a look at the charts and let's break down some of these EMAs, and I'm going to show you a couple different examples here of how we can continue to use these EMAs and in different forms. All right, so if you're on TradingView, all you have to do is go up to the indicators and just type in FXN, and you will see where it says buy and sell signals, EMA 5 and crossover. That is the one that you want to put. Okay, so go ahead and double click on it and add it to the actual indicators on your screen. Now, one thing that I want you guys to do immediately, if you haven't done so already, is if you just double click on any of the EMA lines, right, it'll bring up the settings. What I need you guys to do is to go into style and uncheck the 365 EMA. We don't use that at all. So please make sure you uncheck it so it doesn't appear, because I don't want you making trading decisions off of a 365 EMA. Everything else you leave alone. Everything else you leave alone. It's just literally style and uncheck the 365 EMA. You can change the colors if you want to. I don't care. Do whatever it is that you want with that. Or you can just leave them be. Okay? But that's the main thing that I want you guys to do. If you haven't added the EMAs to the charts, now you know how to do it. And also, everyone, just make sure you uncheck the 365 EMA. So on a 15-minute chart here, look at where the 200 is right here, right? So the 200 is basically above price. So on the 1 hour time frame, this line here represents where price is on the 1 hour. So if you look at the 1 hour chart, here's the 50, right? And you can see the 50 is right above price. The same thing here where the 200 is. This represents basically where 200 represents where the 1 hour chart is on a 50 EMA. So if you look at, like, let's say a 4 hour chart, if you look on a 15-minute chart, here's the 800, right? That's literally right touching. It's literally touching the candle right here, right? So this 800 represents the 50 on a 1 hour chart or on a 4 hour chart. So look what happens on a 4 hour chart. Look at the 50. It's literally touching price right here. Same thing. So if we go back here, let's say, just to make it an easier visual. So if we look at this spot here on the chart, this range is basically like July 16th through the 20th. If we look on on the chart here, here's July 16th through the 20th. So what I want you to notice is essentially that spot and that spot. So this is a 15-minute chart. This is the 1 hour chart. Look at the 200, right? 200 is above price. This 200 line represents the 50 EMA on a 1 hour chart. So if you look at the 1 hour chart, the 50 EMA, this is what that 200 is representing. It's just basically telling you that, hey, on the 1 hour chart, price is well below the 50 EMA, which it is. Same thing on the 800 EMA here. If you look at the 800 EMA on a 15-minute chart, and then we look at it on a 4 hour chart on the same thing, you could see the 800 on a 15-minute chart is well above, obviously the 200 and everything like that. Well, the 800 here on a 15-minute chart represents the 50 on a 4 hour chart. So you can see it's just basically the same thing. It's just telling you that the 50 is still below price on a 4 hour chart. So these higher EMAs basically allow you to confirm the directional bias on a higher time frame without switching to a higher time frame. Because if you go to a 4 hour time frame and you see that price action is trading below the 50, that trend is down, right? Or the directional bias is a sell. Just like if you were to go on a 4 hour time frame and you were to see that the price action is above the 50, then clearly the
the direction, the bias is to go higher. Well, the same thing basically is on a 15-minute chart. Whenever you see 50, 200, 800, right, all of them, and they're all, and price action is all below all of them, the directional bias is to sell. Now, the one thing that I want you guys to understand is that just because the directional bias is, let's say in this spot here, is a sell, doesn't mean that you're not going to get buy setups that happen. Because what do you think happens when we look at a cycle? When we look at a cycle like this, right? The EMAs are going to look like this. You're going to have at least let's focus on the bigger ones, the 50, 200, and the 800. So the 50 is going to be like this. The 200 would be like this, and then the 800 would be all the way like this. The trend, the bigger retail traders, they see this and they're like, oh, well, we're selling because the trend is to sell, right? And so the trend is your friend, so they want to sell. The problem is that they don't understand that price has already moved 3 times ADR, so they end up selling here to keep the trend going. But you should know better because it's 3 times ADR, so you're expecting a reversal. So whenever the big rule that I have is whenever the trend is obvious that a blind person can see it, it's time to start looking at, okay, did we pass 3 times ADR yet? Or are we close to 3 times ADR? Because if the trend is very obvious, everybody obviously is going to want to go with the trend, because every book tells you to go with the trend. Every retail trader's book tells you to go with the trend, right? If you see a trend that's very obvious, you've reached 3 times ADR, 3.5 times ADR, I wouldn't be looking for selling, I'd be looking for buying. You know, especially if you notice like crazy stuff like this right here, like a spike, like a V spike like that, I'd definitely be looking for more buys, not sells. So the EMAs themselves, you're using them for helping you confirm to get into trades for entry, right? You're using them to help you take profit, so you don't have to, do a trade where you're like, okay, where do I take profit? You just take them at the EMAs. So if you're taking a type 3 here on this day, you know that you're going to the 200 EMA. If you go to the 200 EMA, you're going to get about 39 pips or so. Or if you didn't use the EMAs, you'd just be going for 30 pips. Same thing here on this one, a trade out of the edge. 30 pips is just right here, where if you're using the EMAs as take profits, you're able to target 56 pips. You can see here a type 3 trade, again, pins to the 50. Here, type 2 trade, second leg railroad track, goes all the way up. It almost makes it to the 200 or to the 800. That would have been your target here. The reason that you're using ADR is you're trying to project out how far is price going to go before you get some type of reversal, right? If you can project out 3 times ADR, you're projecting out, okay, I'm thinking that price action should go somewhere in this area before I get, some kind of reversal. And if you can match that 3 times ADR with previous structure, so let's just say that if you can map out the 3 times ADR, let's say from this reset down, and if we move this line up just to see where it's at here, and let's just go up to a 4-hour time frame, you can see that line goes straight through a bunch of structure that previously has happened back early in the year. If you go back even further, right from that line, you can see it goes through that structure there, and then goes all the way back to friggin' 2018, where there's structure there. So if you can project all this stuff out into the future, you'll know at least where you should be at. or where price should want to go to. For the EMAs themselves, since that's what we're talking about, on a daily basis, right, you're going to be using the EMAs mostly to just help confirm trade setups, whether they help you or don't, because there's going to be obviously times when it won't help you because the EMAs are not in that area. So like here, if you see that you're bouncing off a 200, you're spiking a 200 EMA, you gotta ask yourself, why are you spiking a 200 EMA? Why don't you go through it? What's so magical about it? There's literally countless of examples where price bounces off EMAs. And so bouncing off of EMAs are just simply used to help confirm. Think of the trade setups like type 1s, 2s, and 3s as a checklist. Think of yourself of having a checklist of, like, I don't know, maybe 5 to 6 things for each setup. So let's say if you're trading like a type 1, right, what are you looking for to help confirm that trade setup? I'd say obviously you're looking for the pattern, right, the timing. Those two things have to be in place, right? And then you can look for how many candles, so 5 or more candles. What else? Is it bouncing off, or is it pinning, I should say, pinning to an EMA? Do you have good confirmation on the TDI, which we'll talk about next? Second leg, let's say railroad track or star pattern. Think about what we just made here of a quick list. Pattern or type 1 setups that you're trading have the right pattern, the right timing, 5 or more candles between the first and second leg. They're pinning to an EMA. The TDI helps confirm. And then the second leg gives you a railroad track or a star pattern. That's 1, 2, 3, 4, 5, 6 things right there that are helping you confirm that a trade setup is good. How confident would you be in taking a trade setup when all these factors are in play versus just having a pattern and timing in play? So if you had a type 1 setup that gave you a right pattern and right timing, and that's all it gave you, versus a type 1 setup that gave you pattern, timing, candles, pinning, TDI, second leg row, which trade are you taking? So now imagine that every time that you take one trade setup or a type 1 trade setup, you're following this list here, and if all these check, you take the trade. If they don't check, you don't take the trade. So we're going to talk about this in the back testing part, because when you have something like this in place, this allows you to look at the market in a very black and white way. It's either there or it's not there. If it's there, you take a trade. If it's not, you don't take a trade. So it takes your emotions out of trading. If you can take the emotions out of trading, you can have way better control over your wins and losses, and also your psychology. So key factors of the EMAs. On type 3 setups, you want to have a pin of the 50. Like for me, I don't take a type 3 setup that doesn't pin to the 50. On type 1 setups, you're not always going to get a pin to the 200, because clearly sometimes the EMAs are not going to be there to help you pin. But you see that there's going to be times right here where they are going to help you pin the EMAs. And a lot of times you're going to notice this stuff as you're going into the London session. You're going to notice where the EMAs are. So if you're noticing that price action is pretty close to an EMA, you're probably thinking, hey, I would want to set up that pins to this EMA. If I'm looking for a sell, let's say I don't know, let's say this right here, I'm looking for a sell here, and I see that the 200 is up here. Like, I wouldn't want price to come up here and pin that 200, because that would just give me a confirmation to take the trade down. But you can see, like, here it goes straight through, the 200 goes straight through it. You still get a pattern to trade. You actually get a second opportunity in the US session.
All right, guys, so I hope that this video brought you some value, gave you the aspect of using the different EMAs, how you can use them in your trading. All right, you can use them in many different ways, many different facets. I hope this video gave you some better insight as to how you could potentially use the EMAs. Again, thank you so much for watching the video, guys. Do me a favor, like, share the content, subscribe to the channel, and we will see you in the next video.